Hi there, I'm Michael Stapleton, the owner of Pro Veritate, a virtual CFO practice based in Melbourne. Now, in my last video, I talked about the balance sheet and the rules that a business owner needs to follow in order to work out where their cash is coming from and going to. Something unique happened as a result of that video. I received my first request. So Mohammed, or if I may, Mo, this video has been inspired by your request. What I'm going to do today is look at inventory and how a business owner can use their financial information to better manage their inventory. Now, it's quite a deep topic, so I'm probably going to split this video at least into two parts. For the moment, I'm going to concentrate on the basics. All right, if you're a manufacturer, a retailer, or a wholesaler, then inventory is probably the largest asset on your balance sheet. So being able to manage it ensures you don't tie up excessive amounts of capital, excessive amounts of cash in your inventory. And the basics, the way you begin to manage your inventory is to make or to do this calculation every month. You're working out your inventory days. And the way you do that is you look at your total inventory at the end of the month. You divide it by the last 12 months cost of goods sold. You multiply that fraction by 365, and the result you get is a number which expresses in days the amount of inventory that you're currently holding. This ratio measures the value of your stock relative to your business activity. Now, business activity is an interesting concept. For most people, they think about business activity as revenue. It's the sales that we make which underpins the activity of the business. But to calculate this ratio, we're using last 12 months COGS, and it's important that you do so, okay? For this ratio, it is the proxy for business activity. And the reason it's the proxy for business activity is that revenue includes a markup or a margin, and that markup or margin will distort the answer that this ratio gives. Think about it like this. All other things being equal, using revenue will overstate the speed at which you think you are turning over your inventory. Revenue, cost of goods sold, in fact, cost of goods sold is the denominator of this fraction. If you replace that with revenue, which is a higher number, all other things being equal, that fraction will be a smaller fraction. When you multiply it by 365, the number of days that you get will be a smaller number of days. It will seem like you're turning over your stock quicker. Do not use revenue, please use cost of goods sold. Let's go through a quick example. If I'm sitting with inventory of $1.5 million and a last 12 months cost of goods sold of $3.5 million, then using this ratio, I can work out that I have 156 days worth of stock. So in other words, at my current level of activity, as measured by my cost of goods sold, it will take me a little over 5 months to sell through the stock I'm currently holding. 5 months. Seems like a lot of stock, doesn't it? So it's an interesting number in that it tells you how much stock you have relative to the activity of your business. But what else can you do with it? How about we work out the size of the prize? And in this case, it's if I've got 5 months stock and I think that's too much, then the question I ask myself is, what happens if I reduce my stock by a month, by 30 days, if I speed up my turnover by 30 days? So, using the magic of algebra and solving for X, where X is the value of my inventory, I can work out that to reduce my stock days down to 126, I need to lower my inventory level down to about $1.21 million. Now, if you remember my last video, you'll know that when assets reduce, it's equivalent to cash coming into the business. So, if I can reduce my stock level by a month, if I can increase its speed of turnover by a month, then my inventory will reduce from 1.5 to 1.21 million. pretty much the equivalent of $2.9 million coming into my business. I reckon I'd be pretty happy if I could do that. What else can I do with this? Well, look at the trend. So if you're not already doing this calculation, if you're a manufacturer, if you're a retailer, if you're a wholesaler, and you're not doing this calculation, start. Go back 2 years, okay? Calculate this revenue every month for the last 2 years. Use your historic financial information and then start calculating it for each month forward. Create a table, create a graph. Look at what's happening. Are your stock days going up or down? Are you turning over stock quicker at the moment than you were a year ago or than you were 2 years ago? Do you have seasonal influences in your business? Are they being reflected in your stock levels? There is so much you can do with this. It is just the start. Now, my next video, we're going to look at some ways that you can actually start to hone in on specific items of stock and take specific actions to actually reduce your stock levels. For the moment, it's the basics. I hope you've enjoyed this. If you did, stay tuned. There'll be another.